What's happening, guys? It's Monday morning. I'm going to give you guys a quick mortgage update on what's going on, where are interest rates, and what is my best assessment on where they're headed. Currently, interest rates are probably around 6.5, 6.625 for a full doc 30-year fixed. And they're elevated. They're elevated because of what's going on in Iran. Oil prices, energy prices, and the cause and effect of that on inflation. Right now, the 10-year is trading a little bit above 4.5. And I anticipate that to stay elevated as the market is starting to digest on oil prices. Because currently what's happening is oil prices have not risen to the amount that we anticipated based on this new escalation, because there's a lot of oil that's being rerouted through other channels. And when that happens, it's fine, right? Oil barrel prices can remain steady for a certain degree. What might happen, and there's some rumors or some news headlines, is that a Yemeni group backed by Iran could potentially close or blockade an export route from Saudi Arabia, which means then, it'll cut millions and millions of barrels of flow going across the world, which can impact oil prices in the United States. Oil prices go up, 10-year goes up, mortgage-backed securities drop, which then the lenders have to increase interest rates to make it more appealing for investors. And that's where we're at, what we're currently at. What we're headed for is a lot longer rate environment, higher rate environment. And that's going to be caused by this new escalation and the fact that it's just ramping up. There really isn't no signs for both sides of a real peace agreement. And so if that continues and it gets worse, and we happen to get troops on the ground, which means longer war. Typically when you have troops on the ground, it means you're going to be a drawn out affair. This means we can have a higher rate environment, and it's sad to say that these are higher rates, but they are, for most people with this type of price range, the 6 to 7% for the next few years. It's likely. So if you're a buyer, you plan accordingly to a longer rate environment, meaning can I hold this payment? Is this comfortable for me? Can I afford this? If you're a seller, you need to try to think about offloading your asset earlier than waiting for a later sale date. Because what could potentially happen is when rates stay high for a longer period of time, the demand continues to dwindle, right? As the economy stresses, consumers stress. Consumers are buyers. And if they start backing out, inventory starts to pile up, more sellers get on the market that have to sell. You might have some foreclosures mixed in with that, some short sales. You're going to start seeing some true effect on the value of properties across Los Angeles. And you don't want to be trying to offload then. So if you're a seller, listen to this message. You need to think about that. And if you can move the asset today, you'll probably salvage some equity than waiting. So if you have any questions, DM me. We can always get on a call. And all my agent partners as well. If you guys need to share this with some of your clients, please go ahead.